Are you curious how a car loan could affect you if you were to get into an accident? Let's start with scenario 1. Say you have a car loan with full coverage insurance. For a real quick explanation, liability plus collision plus comprehensive equals full coverage insurance. So in general, this would cover injuries to all drivers or passengers involved in the accident. It would cover damages to both vehicles and other property during the accident or other events. There could definitely be limits within the coverage depending on what type of full coverage insurance you hold. Let's say you take out a $5,000 car loan out for a $5,000 car. 6 months later, you get into a car crash that is your fault. You swerve to avoid hitting a deer and you hit another vehicle instead. Insurance deems that your car is totaled and cannot be fixed. You pay them $500 for your deductible and you take this from your emergency fund. Thankfully, you have full coverage insurance. The insurance company deems that your car was only worth $3,000 before the accident occurred, and they give you that amount to replace your vehicle. However, you still owe $4,500 on your car loan since you had very small minimum payments to make for the last 6 months on your car loan. You put that $3,000 from insurance towards your car loan, which leaves you with $1,500 left of your old car loan that you still have to pay even though you cannot even drive that car. You still need a car though, and you find a used $5,000 car. Since you don't have money set aside, you now take on a new $5,000 car loan. This leaves you with $6,500 of loans that are accumulating interest that you now have to pay for your car that you cannot drive and for the new car that is a depreciating asset. This also leaves you with higher insurance premiums, little or nothing left in your emergency fund since you used it to pay your insurance deductible. And it also leaves you with a whole lot of stress and headache. You think that scenario is bad? Wait until you see scenario 2. Say you have a car loan with only liability insurance. For a real quick explanation, liability insurance is the minimum coverage required for all drivers. It is illegal to drive without insurance. Liability insurance covers injuries and damages to other vehicles or property if the accident is your fault. It does not cover costs accumulated for you or your vehicle. There are also payout limits with this type of insurance. The situation is exactly the same, except that since you only have liability insurance, you will not get a cut from your insurance for your vehicle. You still owe $4,500 on your car that you cannot drive, and you need a car to drive, and you find a used $5,000 car. Since you don't have money set aside, you now take on a new $5,000 car loan. This leaves you with $9,500 of loans that are accumulating interest that you still have to pay. It continues to leave you with a car you cannot drive that you're still making payments on, a new to you car that is a depreciating asset, higher insurance premiums, little or nothing left in your emergency fund since you used it to pay your insurance deductible, and a whole lot of stress and headache. The reality is that debt carries a lot of risk. Debt equals risk. I understand that some people like to cut costs by only carrying liability insurance, but I hope you understand how dangerous this can be if you have a car loan. And even more especially if you don't have an emergency fund to cover the cost to replace a vehicle or cover damages that your insurance might not cover. No one plans to get into an accident. We all try to be safe drivers because we don't want to get into an accident and deal with all the consequences that happen because of it. But some things just can't be prevented. Like, for example, a deer running out in front of you and you running into it, or a tree falling on your car during a storm. Full coverage insurance would cover your vehicle and injuries in both of these circumstances. There is good news. Having a paid-for in-cash car with full coverage insurance would completely change the situation if this same accident were to occur. The beginning situation would be very similar as the others, except that you would have no car loan that you're making payments for, and you'd have a car that you'd own. That $3,000 that your insurance gives you to replace your vehicle can be put towards the purchase of your new car. Because you didn't have car payments that you were making every month, there's a good chance that you probably would have a vehicle maintenance fund or a fund saving for a future car. You would have money set aside, most likely in this situation. You could then take this money and add it to the insurance money and buy a new to you $5,000 car. This would leave you with no worry about the crashed car because you have no financial attachment to it. A car that you now own in full, and you would have higher insurance premiums, yes, unfortunately, because of the accident. However, you'd have an emergency fund that will start growing very quickly again because you have no debt payments to make. This would leave you with freedom. Although the accident was a minor inconvenience and very frustrating, of course, you have a thankful heart because your finances were in place and you were prepared for such an emergency.